All right. I'm here with Tom Shipley, and he is both an entrepreneur and an aggregate entrepreneur and investor. So how you doing, Tom?
I'm doing great. Great to see you today.
Yeah, I'm excited to really unpack what, an aggregator, investor does and an entrepreneur like yourself is involved in. But before we get to your successes with e-commerce and platforms, let's talk about your background. How did you get started?
I think that I've always been an entrepreneur, and when I got out of special forces and came to the United States, came back, and I was starting my life again, it seemed natural to me. I have an idea, and therefore, let's go and pursue it. But I'm going to say is there's one thing is your initial ventures that you do as an entrepreneur, but then there is what really got you into what you consider real businesses. So I'm gonna just share that it was 1999, and I had this fire in my belly. I tried to buy some businesses, even though I had no background into it, and I was doing consulting. I tried to buy some one of my clients' businesses, and at that period of time, especially online valuations, 1999 started getting out of control. It was cheaper to build than buy at that period of time. So, and everything was new. So that's exactly what I did is I decided let me launch something that I had this big vision for of a real market opportunity. There was a strong gap in the marketplace, and I opened an online store. I always believed in omni-channel marketing, and therefore I mailed millions of catalogs every month. We grew to about a dozen pages in the Sky Mall magazine. It was a great business. And then what's germane for your listeners today is then what happens? So you have a great business is growing, you're at $500,000 in revenue, sounds great. And then what? Well, then there was the dot-com bust. What happened is there's always a first, second, and third order impacts to things that happen. The first was the market meltdown for dot coms, but that pulled the overall marketplace into a recession. Conversion rates goes down, and what's the next impact? Conversion rates goes down, average order goes down, and we, as our business, we start losing money. And my CFO came to me and said, Tom, we have 30 days of cash left, and I'm an entrepreneur. And I said, that's not true. I knew there was 90 days of cash and I could squeeze it out. So, but we were obviously challenged because in 90 days we wouldn't be able to meet payroll. And in this case, it was opportunistically and luckily an investment banker that I met at a conference called me up and said, Tom, I have a great acquisition opportunity for you. And I'm there again, young, little bit just, I believe in myself. And so I said, okay, tell me about it. And he was representing Boise Cascade. They were selling a $750 million division. Now, again, he said, I have a buyer for this, but they have a $15 million division. They need a buyer in order to be able to close this deal. And he said, you're the perfect company to buy this. It complements your business, which is great. Again, everything is about seller motivation. They were more concerned with finding a home for this business than they were the terms of the deal. So I was able to negotiate terms to buy this business, able to get an ROI on this business within 30 days, and able to exit my business 12 months later. And it was the first lesson I learned without any background in acquisitions about how the fallacy that you need capital to do an acquisition is not true. It really starts with seller motivations, and that this deal solved so many of my business challenges.
Wow.
And so that was my first introduction to acquisitions. And then it wasn't a way of life or a way of building a business until 24 months later. 24 months later, myself and a new partner I had in Richmond, Virginia, two former special forces guys had this crazy idea. We were going to build $100 million beauty brand using direct response marketing. In 2005, that's not the way how you build beauty brands. And everyone just ridiculed us, laughed at us because they said, you'll never do it. You don't understand beauty, nothing about it. And I just knew unit economics and great storytelling conversion could work for us. And within a year, we proved it can work in radio, print, and online. We just had one problem at $331,000 in revenue, Steve. We ran out of money. And so, but I mean, not the business ran out of money. Our credit cards were maxed. We took loans out against our cars. Our mortgages, we were tapped, and we both had two small girls at home. And we were trying to think how we're going to feed our families. What do you do when you run out of money? Playbook number one is you buy business. We bought a $15 million supplement business in Hoboken, New Jersey, doing $1.5 million of EBITDA. But they had a great tech stack and they're great internet marketers. They had fulfillment, everything we needed. We put our little $331,000 skincare brand on top of this platform. Because remember, acquisitions can solve almost every business challenge. And within 3 years, we did $100 million in revenue. We did $1 billion of revenue on that first skincare brand. And then
Wow.
we created Wrinkly Beauty. We created a new category of women's hair regrowth with Keranique, and again across multi channels for everything from infomercials to always strongly online to retailers, Sephora, Ulta, CVS. So it was amazing business that we exited in 21 to private equity. But it's that foundations of what you learn and the systematic process in doing acquisitions.
Mm. And wow, that's incredible. So how did that deal work? I have to know a little bit
Okay,
there with.
like very, very, very good. So in that situation, it was two young entrepreneurs and a couple. And this is before they got married, and they built this business over 5 years. And it was a great boutique business that was growing really nicely. And so, someone lending, if you have a startup idea, you going out and getting funding is rough, is very difficult. And for us, we had metrics, but again, the leap of faith to what we needed in capital and especially the infrastructure we needed to build was big. Versus if we bought a profitable business that was growing every year, the debt lender, and we got a mezzanine lender, and basically as we went out, let's start with real basics. Basics is we got referrals to someone who is a broker who specialized in this, in mezzanine, in debt financing. Then Ken went out, he redid our book, he created a presentation, redid our models. Then he went out to people and he did his more or less internal underwriting on us. Then he went out to people in his network, shared our book. Four people came down to Richmond, Virginia. We sat, gave a presentation. We got two term sheets on that for mezzanine. Now, what's mezzanine level capital? Again, there is your different types of debt. Mezzanine is typically a little more expensive, a little higher interest rate, and they always top it off with a little bit of equity in your business. So they can their goal is to an average return of about 25%. But from my perspective, if we were to raise pure equity, we would have to give away most of the business to raise the money that we needed. So debt is a great vehicle. And we knew we were so profitable that we could pay this off. And obviously the return we got on the investment was extremely significant. But we bought 85% of the business for cash, 15% rollover. Now, typically I do a lot more rollover now than I used to, and seller notes and everything else, but I didn't know that much back then. But we did 85%, and 3 years later, we bought out the remaining 15% of their equity for the same amount of cash that we paid for the 85. Because we scaled it, we increased value, and from my perspective, this is the home run situation where we got a great business and got everything we needed to build what we had our vision. We had basically our vision. And at the same time, they got the dream exit. And at the same time, we allowed them to do, and their team to do a side business, which grew into something significant. So when we parted ways at the end of 3 years, they were in a great situation. They had a really nice payday. They made smart investments. And for us, it was great for us. It created the foundation for what a business that was doing between 70 to 110 million every year for 15 years.
Wow, very cool. So there's quite a bit to unpack there, and I'd love to start with preparing a business for an exit because there were multiple exits in there. I'm curious about the one in 21 to PE, and if you could share some kind of knowledge around how to prepare a business.
Yeah.
I think that's something that I get all the time is like,
And
how do you get ready?
I know we are very short, so I'm just going to spin a couple other data points into what we're doing now, just to give some context, okay, is in 20, with a friend of mine, we launched a platform to buy Amazon e-com brands. We raised $100 million from two amazing private equity firm, and that's how we started Foundry Brands, which was focused really on personal care and a great portfolio of brands. But through that and through my next businesses is where I'm going to say I perfected our playbook in programmatic M&A, which is basically your SOPs. I'm an industrial engineer by background, make it complex and make it simple. in which and after that, I took that same playbook and applied it to advertising agencies, bought a number of agencies, exited a number of agencies. And for the last 3 years, I work with entrepreneurs through our DealCount CEO M&A Summit, where we pull 150 entrepreneurs together. We get to teach entrepreneurs how to not only scale through acquisitions, but also through to exit, and how to prepare your business and take care of a lot of the discount factors that will reduce it. And something that a lot of people don't talk about, Steve, is sometimes the best path to an exit is through an acquisition.
Hmm.
You know what I
How
mean by
so?
that?
No, I don't.
Two reasons.
What's that?
Let me throw out two things. First of all, let's talk about when you look at a business, a lot of times when you go to sell, there might be some material risk to the business. The biggest one is concentration risk. How many, if you have certain clients or a product line that is the majority of your revenue, someone comes in and says, yeah, something happens there, you don't have a business. So it's tough for someone to get a good deal for you to get a good deal on the market. You can grow out of that and experiment and test over time. The other way to do it is you do an acquisition. Let's say you have 70% concentration risk in your business, but you do a couple acquisition. Now suddenly your diversification brings down. That business can end up, depending on the size of the acquisition, can end up being 30% of your business, for example. You might have you might have a great really a great company, but you're not great operators, and you can buy an agency that are not great at business development, but are great operators to actually fill that piece, that gap for
Hmm.
you. So it's like, what are your biggest challenges that you're facing, and can you do it through an acquisition? There was a woman that came to our last summit, and what she was looking at strategic alternatives and looking at ways to exit, but they had one or two challenges, including a little blip in their revenue. Um, and on their way to do an exit, they said, let's push it off for a year. And they did an acquisition of a company that was great in a niche they didn't have. But with that growth of that smaller business and combined, they had a lot stronger of a business, and they're positioning themselves for sale. So, and the other thing I'll share with you is the game of multiples. And let me just share one stat with you is that if you buy one business, nothing crazy, you focus on acquisitions is the way you do building a sales channel or developing a product. You buy one business every year that's half your size for 5 years, you will increase your enterprise value by 1,200%. If you spend the same amount of time and grow your business by 10% per year, you'll increase your enterprise value by 50%.
Hmm.
Yet the number is outstanding because two things want to happen. One is you're stacking your EBITDA, but also the more profit you have, the different level of what people will pay for you, because it becomes an issue of your larger company, larger EBITDA means you're more stable. The other thing they look at is you're also getting into an area that larger you are, the more dollars there are, serious dollars that will invest in that sector, in that size business, and there's a lot less competition. So in order for them to find and buy businesses, whether it's strategics, whether it's private equity, at a certain size, they're going to have to pay you more because of the competition that's out there. So the way you can add your own EBITDA, increase your EBITDA, is through acquisitions. So it depends on your timeline for exit. If your goal is to exit within the next 90 days, is one thing. If your goal is then you're having a different strategy for maximizing the look and feel of your business and positioning it. If your exit is 1, 2, or 3 years away, if it's 3 years away, you got tremendous amount of runway to address a lot of issues and really maximize your exit. And everything comes down to what is your goals for your exit.
Hmm. I like that this is a good segue into valuation and kind of driving value. I think there's a
Hmm.
lot of questions that people bring to me on a regular basis about what they can do today, right now, to increase the value of their business, whether it's an agency like you'd mentioned or an e-com business. And you mentioned that really remarkable stat of 1,200% just buying a business that's half your size every year for 5 years. I really think I've never heard that before, but it's a really quite compelling concept of kind of increasing that EBITDA to exit eventually with that. So when it comes to actually driving value for people listening right now, what's something that they can do to put their best foot forward with increasing that
Okay.
valuation?
Okay. First of all, when and I'll talk as a buyer. When I'm looking at a business, the first thing I'm looking for is what are some of the risks of the business? I'm looking for signs of risk. So first
Mhm.
of all, your books should be in order and books clean, because if I'm coming in and someone's books are a mess and there's a lot of issues that are arisen out of the books, therefore bring a professional and you're doing it for sale, making sure that your books are clean and organized from your accounting entries, entries, the structure of your financials, the placement, and basically you have great historical and have easy access to that, as well as all your corporate records, and really clean up your business to prepare it for sale. Because that's then the next thing I look at is what are the you're an inside expert on your business. So what would you feel uncomfortable for someone looking at? If they see that I have a concentration risk. When you solve that in any ways, meaning that most of your revenue is coming from a single source, can you address that? Can you solve it? Or can you get the person more confident through contracts, through other things, that this is a good business with lower risk? Um, so look at the revenue, look at your team. How strong is your team? Are there things that a buyer would come and immediately make changes because you're weak in your team or you're carrying too much overhead? Well, just take care of that, and therefore you're going to get the value through an add back through your enterprise price value. Imagine that you're the buyer for the business, and what is the first thing you do over the first 12 months of the business? And the question is, regardless of how painful it is, why aren't you doing it?
Hmm.
And a lot of times we're sitting status quo. We don't want to, we're kind of walking on eggshells. But you know something? Do the right thing for your business. And ultimately, I always say that bu- build a great business that is sustainable and strong and with great margins, and there'll be a lot of buyers for that.
Hmm.
And look for low
I,
hanging fruit with opportunities. Look at your pricing. Is your pricing, if your conversion rates is very high, your pricing is too low and you're leaving all your margin on the table. You drastically increase your margin. Are there things that you're on your wish list? What are the 5 things that you can do to drastically increase the profitability of your business and the margin of your business?
mhm.
So there's
And
just
I
a
think
list of things to go through.
there's a fun thought exercise that this reminds me of is if you're a buyer, like you're currently operating a business and you're listening to this, think of it, you're the buyer walking in on day one. What are you doing
Hmm.
to improve the business? And
Hmm.
it's like
Hmm.
raise
100%.
prices, dig deeper into all the different line items, figure out which vendor you need to negotiate with.
Right.
And it's amazing how that thought exercise can literally just spark people to optimize, get into their business and kind of fix things that they should have done a while ago, and just kind of role playing in their head a different perspective can often get you sort of out of the weeds of operating.
Steve, that happened to us in my business. Is we had a buyer come in. This goes back to 2018. A buyer came in and we had several meetings with them. Then they put together their whole team and the consultants they were bringing in. And then they sat around the table asking a lot of questions. Then they shared with us what they would do with their business to get excited, for us to be excited to roll in more equity into the deal. And then they left, and I turned to my partner. We looked at each other. We said, why are we selling the business down? We've always talked about these things, but we haven't executed on them. Let's
Yeah.
finally just go. And it gave us a fire in our belly. And that's exactly what we did. And the ride was amazing and incredible after that, the next phase. But that's just happens. The other
Yeah.
thing I'm going to share with some of your listeners is be very careful of being in a perpetual process. And the reason why is that, and I'll give a classic example of what happens. You meet someone, they say, introduce you to a friend of mine who's an investment banker or a broker, and then you talk to them and they said, oh, wow, I'll tell you what, I know you don't want to go to the market right now, but let me just introduce you to a few people. Would that be interesting for you? That might be buyers down the line. There's nothing wrong with that. But then suddenly you have this conversation and then they start saying, okay, love your business. Now send us this information. Now suddenly indirectly you're in a process and the investment banker is then expanding it and putting together a book, and you're spending your time on the data room, you're taking your attention away from the business, and now you've unofficially and officially gone to market. Now what happens when you don't close a deal because you weren't ready to go to market? Now suddenly it's kind of like the movie Draft Day, where your number one draft pick gets passed, and then everyone else says something's wrong with that. You thinking that you're going to go out next year and go back to market? The answer is no, you're not, because everyone looks at you as an asset that has a business that has some challenges. You have to wait a couple of years. So be very careful about going to market. It's great to build relationships with potential buyers, but until here, don't share a lot of information because you're not in a process. You are developing relationships, and be prepared. Now, that said, sometimes the right buyer shows up at the right opportunity and you jump on it when everything is aligned, but be very, very careful.
Mm-hmm. And that almost answers my next question is around mistakes, my favorite topic that a lot of people listen to this show just specifically about mistakes, and some of the ones that you've seen, some of the ones that you've made. What are some of the ones that immediately come to mind when you think of
So
mistakes?
I'll start with mistakes. Okay. There's on the buy side and the sell side. I can tell both nightmares. Okay. On the sell side perspective, know your buyer, and especially when there are payment terms, make sure that first of all, you understand who you're selling to, that you do your due diligence on that you actually find out from as much different points in your network. And even if you can hire people to actually do some great research on who you're going to be selling your company to, especially if there is rollover equity and seller notes involved, because frankly, it's at risk. You may never get paid by it. No matter how amazing the top line story is, I've seen the biggest companies blow up. So be very, very careful and very cautious with who you're selling to. Don't be over scrutinized, because I've seen paranoia get in the way and people not close deals for the silliest reasons. But also, so that's it. Make sure you have invest in a very strong deal team around you. Your most important resource is your attorney. And there are deal makers and deal breakers. Most attorneys I know want to show how they are protecting and fighting for you. And I've seen them blow up deal after deal because they were sowing seeds of doubt in their client's mind and getting them paranoid about every little things. There are material things and not material things. After 25 years of doing this, the reason I have my attorney, the one I use, she does 100 transactions a year, is she's an expert. She knows the terms. She knows it's reasonable, and she will find. You always look for the Venn diagram opportunity of your needs and the buyer and the seller's needs and that area in between. And she's an expert on how to find that. And then also to say, as the other attorney's battling, saying, something that's a business issue, that's not for us to negotiate. That's for the buyer and the seller too. The other thing that I do in the beginning of any process, whether it's on the buy side or the sell side, this is really important. It's a conversation I have. Because things are amazing at the very beginning. So what I always say is understand that we're going to go through this process, and our advisors are going to try to pit us against each other and sow seeds of doubt into the intent behind what we're doing. And I can tell you this is, when you're reading a clause, your attorney says, oh my God, they're trying to screw you because of this clause in the definitive purchase agreement, stock agreement, whatever that is. What I said is, don't lose sleep about it. If something smacks you into a big issue, or something that you think there's some negative intent there, do me a favor, pick up the phone and call me or text me, and we'll get on the phone right away. You and I will be able to resolve almost every issue, but I don't want you to lose a night of sleep. I don't want you to be sitting there thinking at nights bigger, because typically it's communication, and it could be something that I did not understand or my attorney didn't understand that you can help clarify, and we can quickly resolve almost every issue. But we got to be very careful that our advisors are there, whether it's tax, whether it's legal, whether it's operations, doesn't really matter, to protect us. But they can also stir the pot and create issues out of nothing and blow up deals. And more often than not, is the break of trust for miscommunication why deals do not get done.
I like that. Saying just call me. Skip the
just that. Make it very, very easy. Text or call me, and let's not lose sleep. And do not think in any situation that you have to go through the attorney every time. Yeah. Because if we don't have a relation, because the most important day that happens and the most important 90-day period is what happens on day one, the day we close. Mm-hmm. If whether I'm buying or selling, you're talking about all your people or all my people are going to you or they're coming to me. your clients, your relationship, your reputation. Therefore, is day one's the most important thing. If we exhausted all our goodwill and we are just don't like each other by the time we close, we have a problem because the real work and the excitement starts on day one, and there'll be things that will be missed that we have to collaborate together in order to address. And therefore, as much as we have goodwill and good relationship, and therefore, if we have things in advance, let's work them out. Like the thing that creates so much friction almost every deal that I've seen is, and Steve, you've seen this, in working capital.
Hmm.
Working capital, the money necessary to continue operating the business, how you define it, the earlier things that are done and the process is done, rather than 30 years after the fact, one party's accusing the other person is, well, the bank account was there, receivables came in, you didn't turn it all the way over, use that money to pay your personal expense. I've seen that over and over again. The tighter you can make the process, and really the business suffers, and you don't want your team and your clients to suffer from the transaction.
Hmm. I like that. That is one that truly someone who's been in deals knows. Working capital is like a attention
It's
beyond
attention.
belief.
And if you address it early with clear processes and procedures is great. The other thing, Steve, if you're buying a business, the thing to say is be the two biggest dangers in buying a business for an entrepreneur is desirability bias and commitment bias.
Hmm.
Desirability, we see what's possible, and that voice in our head tends to discount the warning signs. The commitment bias is if you're an entrepreneur, it means you get things over the finish line, you get things done, and we will get things done that no one else can. And therefore, when we're saying we have a deal at hand, we will get it done. However, not every deal is meant to close. You're going to identify things in the due diligence process where it gives you warning sign. And due diligence is there for a reason. It's there to identify things that need to be solved in order to get the deal done. In the legal docs, they can be addressed with reps, warranty insurance, things like that. Or they're small enough, but it's on the project plan to get taken care of after the deal is closed. Okay, so that's what due diligence is there for. However, we can discount those factors and weigh them off, those warning signs. And really, we just need to make sure that they're addressed, and having people around us that can tell us the truth without being fearful that where they are getting in our way of making a great thing that happens to our company is then blocking it.
Hmm. Well said. Well said. Well, that takes us to the finale. Knowing what you know now, what would you tell Tom 10 years ago?
Um, 10 years ago is understand is that the fastest and most clearest way to grow your company is through acquisitions. If you do it properly, and I'm not talking about people that read a book or listen to a bunch of Instagrams or YouTube videos on it, is if you understand and take the process seriously, you can be doing acquisitions every year, which will change the destiny of your business and position you for the right exit at the right time. At a certain size, almost every business does that. And when whoever buys your business will be doing this. Why aren't you? So 10 years ago, going back, I was doing it opportunistically. I'd wait for the opportunities to come to me. And now I fill my calendar up and I have seller conversations every week. It's very easy. Basically I have a third party doing it. I used to just set it up internally, have my VA doing it. It shows up on my calendar. I'm having amazing seller conversations every week. And therefore, those once in a lifetime opportunities are there on a regular basis versus coming every few years.
Hmm.
And that's what I'm telling myself is acquisitions can help you solve almost every business challenge, identify the path where you're going to go through, and then how you can layer this on into just part of the DNA of your company, regardless of the capital you have, regardless of the challenges. Keep your mind open and just follow the process. So that's what I'd be telling myself 10 years ago.
Very cool. So that takes us to what you're working on now. Where can people find you and figure out what you're working on?
Perfect. So we're right now. If the one thing I'm going to share with you is that I love impacting people's lives, especially at our DealCon M&A Summit. These are 150 entrepreneurs and 7 to 9 figure entrepreneurs. Check us out at dealconlive.com, DEALCON live.com. And it's the most generative, action oriented, really great entrepreneurs that get together. We bring in incredible speakers, and those events are meant to be transformational in your business, whether you're a buyer or whether you're buying businesses, whether you're building an aggregator to roll up businesses or you're selling your businesses. So that's the first thing I share. You can go look at Tom Shipley on LinkedIn, Facebook, and Instagram. I do a lot of content there. tshipley.com is my website. And then I'm launching my next roll up platform in Q1 of next year. My first two groups I'm putting together are in the agency space. And that's a great conversation for a different day.
Very cool. Well, thank you so much for coming on and sharing all your wisdom, Tom.
My pleasure. It was great talking to you, Steve.